why you chose to be an investor?
See, my journey started when I was in my, I think, ninth or 10th standard. My uncle who actually introduced me to the markets. When I would have read the technical analysis books, I would have read, right from Graham to, Phil Fisher to Peter Lynch to Warren Buffett.
You started as an individual investor and later on you are now managing a 1700 crore portfolio. So what were the turning points?
See, the journey was not easy, right? So we started in 2015. So there were a lot of issues like demonetization, GST implementation, Brexit, you name it. COVID was there in 2020 later.
How you would like to inspire others to have a process, and what was your process? How was your journey?
The market a river of opportunity, right? Just like a river where different people can utilize the water in a different way. Similarly, the market gives you many, many, many ways to take money out of that river.
I would like to have first-hand account of one of your biggest success, which if you would like to share with us.
हाय फ्रेंड्स, स्वागत है साधन के एक नए जोरदार एपिसोड में जिसमें हम लेकर के आए हैं एक टॉप 40 अंडर 40 फंड मैनेजर जिनका नाम है मिस्टर प्रभाकर कुडवा. ही हैज बीन अ सक्सेसफुल पीएमएस फंड मैनेजर. उन्होंने अपने फंड को 45% से ग्रो किया है इन लास्ट 4 इयर्स. ही हैड अ क्वाइट इंटरेस्टिंग जर्नी. उनकी जर्नी के बारे में बात करेंगे और साथ ही साथ उनसे सीखेंगे कि इन्वेस्टिंग में अप्रोच कैसा होना चाहिए, स्टॉक मार्केट में कौन सी पोर्टफोलियो एलोकेशन स्ट्रेटजी लगानी चाहिए फॉर कॉमन इन्वेस्टर लाइक अस. और इन्होंने काफी सिंपल टर्म्स में बताया है इस पॉडकास्ट के माध्यम से कि हमारे लिए टाइम फ्रेम कितना इंपॉर्टेंट. साथ ही साथ उन्होंने एक बहुत इंपॉर्टेंट चीज बताई है जिसको पर्सनली मैंने फॉलो किया है एंड आई हैड बेनिफिटेड अ लॉट, एंड दैट इज टू बेनिफिट फ्रॉम अ स्ट्रेटजी कॉल्ड अर्निंग सरप्राइज. सो किसी स्टॉक के अर्निंग को स्टडी करना और उसके बेसिस पे इन्वेस्ट करना, दैट हैज बीन अ फैंटास्टिक आउट परफॉर्मिंग स्ट्रेटजी फॉर मोस्ट ऑफ अस. सो इस स्ट्रेटजी को डिटेल में समझेंगे कि स्टॉक को कब बेचना चाहिए और एक फंड मैनेजर स्टॉक मार्केट को कैसे देखता है, जिसे हम देख करके सीख सकते हैं एज अ रिटेल इन्वेस्टर, एज अ स्मॉल इन्वेस्टर. वी आर गोइंग टू immensely benefit from this podcast. So stay tuned till the end of this video and like, share and subscribe Sadhan for more knowledgeable content exclusively for you. So welcome to the Sadhan podcast.
So first of all, thank you, Prabhakar sir, for giving us the opportunity to host you on this platform. We are a bunch of retail investors trying to learn investing, and you have been a good teacher. That's why we are here to learn from you. And the idea of this podcast is to bring the real investor inside you to the public knowledge, because of certain regulations and because you are working in a regulated field. Sometimes you might not be able to get a chance to really educate the retail investor who may feel left out, but you have amply tried to share it through blogs where we admired your works. I've been an admirer of your work since last 4 years. I would like to begin with your journey. How have been your journey? Why you chose to be an investor? And if you talk about your early days, that would be great for my audience.
Sure. So first of all, thank you for inviting me. It's always a pleasure to share whatever little I've learned, right? Yeah, to start with, see, my journey started when I was in my, I think, ninth or 10th standard, about 16, 17 years. So my dad was a banker, and we were living in Delhi for a long time, for about 8, 10 years. And we used to come to Karnataka, which is my native place, every summer vacations. It was my uncle who actually introduced me to the market. So he was a old-time market participant, and he was actually big in technical analysis and all that. So when I used to come to my grandmother's place for the vacations, he used to make me sit with him for hours, and we used to go through charts and all of that. So that is where the interest, initially started. And I, for whatever reason, I found the whole idea of markets very stimulating, and it was, quite interesting to me. So I continued that interest, and he also gave me some books, and I started reading some books. Although he was more heavy on the technical side, at that time, I think this was the late 90s, maybe. So YouTube and all of that was, hardly there. I think it was not even there. It was mostly books, right? So I read a lot. I would have read the technical analysis books. I would have read right from Graham to, Phil Fisher to Peter Lynch to Warren Buffett. So that journey kind of started of, reading across the board, whatever I could lay my, hands on. So two things which really, I think, made me kind of stick to the markets, right? So one was I realized very early that market is a meritocracy, right? So in the sense that if it's a like what people call a single player game.
I'll play game.
So if you're good, then you're good. If you're bad, you're bad. The results are
Mhm.
out there in front of you. So it's you and the market, right?
Okay.
So there was nothing. So, and being a bit of an introvert, right? So I'm not very social. I kind of pleased my nature, to do something on my own, and do your own analysis, do your independent thinking, and
Mhm.
if you could earn money like that, then nothing like it, right? So, and secondly, it markets are very intellectually stimulating, right? So even to this day, right? Why somebody like Warren Buffett or Charlie Munger, these guys continue being involved with the market, into their 90s and, into the late, touching close to hundreds, right? Is
Mhm.
because it's a very intellectually
Right.
stimulating game, right? I call it a game. I think I see it as a game. So, right from reading a lot, pattern recognition, applying a lot of common sense, then comes the whole psychological angle to it. So
Mhm.
put together, right? It's a very hard game if you think about it that way, but it is also very intellectually stimulating for people like me who loves reading, who loves analyzing, who loves to read about the world around and make sense of it. So those are the things which really kind of kept me involved with the markets. Otherwise, any other job, right, you will typically get bored after a few years, but
Right.
markets don't allow you to get bored, right?
Mhm.
So, there's always the ups and downs. So performance and, all of that has, now become, as more a side effect, right? It's
Okay.
more because you just want to be involved with the game. You want to play the long-term game. You want to be involved with the markets, keep learning.
Mhm.
So that is how the journey kind of started, and that's how it grew. And here we are today.
That's wonderful. That's wonderful to note that you started as an individual investor and later on you are now managing a 1700 crore portfolio. So what
Yeah.
were the turning point? Because normally lot many investors start as a hobby. What was the turning point that made that jump for you that kind of shaped your career in finance domain?
I'm a computer science engineer,
Mhm.
but I always had that hunger, in the back of my mind that I somehow wanted to break into the markets,
Okay.
right? So even while I was in college, I used to be more focused on markets than on engineering.
Okay.
So I was always, looking for opportunities because no buy side or sell side will hire an engineer. But if you are a research analyst or you want to be, something where you eventually want to become a fund manager and all of that,
Mhm.
there is no way you can break in as an engineer. So the obvious next step was, to do an MBA, break in through the MBA route. But parallelly, what I was also doing was I was kind of helping my family, friends manage the money. Obviously, unofficially at that point in time. And at that
Mhm.
point in time, there were not so many regulations also, but mostly people I knew, right? Not like public at large and all that.
Mhm.
And I did fairly well, and people around me knew that I was, good at it. So I continued, I was working, and then, my cousin who was a co-founder of another tech company, right? So which was related to capital markets called Omnisys. So we were building software for most of the brokers, even today, the largest brokers like Zerodha and
Mhm.
Motilal, Edelweiss, they use the
Okay.
same platform, right? So I joined that firm and I was there for about 5, 6 years, and then that firm was sold to Thomson Reuters. And
Okay.
post that sale, my cousin who was one of the co-founders, and he was also very much aware of my interest in the market. So he said that now that the sale has happened, we have to do something new. So that is how Samvetti was
Okay.
formed in 2015. Even he happens to be an engineer, and I have another third partner who's a chartered accountant. The three of us kind of came together. It happened because I was continuously involved with the markets, right?
Okay.
And I was, talking to people about it. I was helping some people with it.
Mhm.
So because of that journey, people, around me recognize that, okay, this guy has some talent or some interest. And
Mhm.
that is why when the right time came, the opportunity sprang up. And we set this up around, I think, almost 10 years now. So
Okay.
2015, we started, so about 9 years. And
Mhm.
we started Samviti, and we again started, as an AIF and a PMS, managing money for our own family and friends. Because
Mhm.
initially, like, who else will give you money, right? So we started with about 40 crores of AUM,
Okay.
and I think today we've reached. I think as we speak, we've reached about 2,000 crores.
Oh, that's
It's
great.
in about 9 years. So that is where we are.
That's the real compounding at play.
Yeah, yeah,
Yeah.
absolutely. Now the markets have also been very helpful. But
Yeah.
we did Samviti, the journey was not easy, right? So we started in 2015. So, there was a bull run till 2017, 18, and then, how bad the market was from 18 to
Mhm.
20. especially for mid and small caps.
Hmm.
So there were a lot of issues like demonetization, GST implementation, Brexit, you name it. COVID was there in 2020 later. We went through a lot of ups and downs, but every year we picked up, more experience and we learned and we brought that into the fund management. And I think after that, when this bull market started, I think we were really completely ready to kind of, participate into it. And we did exceedingly well over the last 4 5 years. We beat the benchmark by a big margin. Even before that, we were doing it, but the margins and all were not that big. But whatever we learned from those difficult years, we put them into, a framework, into, a process, and post that, we have not looked back. Of course, the markets also have been good. It has been quite a journey the last 9 years.
Oh, that's amazing to hear. Since you talked about you have a process, you have always been improving upon it. So my audience here is a retail investor and who are struggling with this idea of investment framework and investment process. So if you can just dig a bit deeper in a slightly layman's terms, that if somebody who is watching this video can think how to go about stock selections, because the market is so frothy at this point of time, people are just looking at their greens into portfolio, and the process is the last thing in the mind. How you would like to kind of bring this discipline of investment process, how you would like to inspire others to have a process, and what was your process? How was your journey to have a investment framework which you currently holding?
And let's start from the beginning, right?
दोस्तों 2 मिनट का टाइम आपका लूंगा टू एक्सप्लेन 3 कोर्सेज. सो फर्स्ट वन इज यूट्यूब प्रो या साधन प्रो जिसे कहते हैं. उसमें कंटेंट डिलीवरी जो है वो मंथ में एक बार होती है, और साधन प्राइम में भी कंटेंट डिलीवरी मंथ में एक बार होती है. वहीं प्रैक्टिशनर मेंबरशिप में जो मेंबर्स होते हैं उनको कंटेंट डिलीवरी लाइव बेसिस पे होती है. अब बात आती है लर्निंग एक्सेस की. सो जो साधन प्रैक्टिशनर मेंबर्स हैं उनके लिए हमारा लर्निंग मॉड्यूल है learn.amitabhvatsya.com. वहाँ पे हमने जो लर्निंग मॉड्यूल शेयर किया हुआ है जो कि उन्हें एक बेटर इन्वेस्टर बनाता है. साथ ही साथ हमने एक टेलीग्राम कम्युनिटी डेवलप की हुई है जहाँ पे मेंबर्स आपस में इंटरैक्ट करते हैं. दे टेल अस व्हाट दे आर थिंकिंग, व्हाट इनसाइट दे हैव. तो हमारी कम्युनिटी से एक म्यूचुअल लर्निंग वाला बेनिफिट मुझे भी मिल रहा है और पूरी इस कम्युनिटी ग्रो कर रही है. तो वो एक्सेस जो है वो सिर्फ साधन प्रैक्टिशनर मेंबरशिप के लिए है. वो एक्सेस साधन प्रो एंड साधन प्राइम में इंक्लूडेड नहीं है. मैंने जो एडिशन किया है या डिलीशन किया है वो विथ थीसिस मैं शेयर करता हूँ अपने साधन प्रैक्टिशनर मेंबर्स के साथ. आई लव टू डू एम ए विथ माई साधन प्रैक्टिशनर मेंबर्स. वहाँ पे इन्हें पूछना है, दे कैन एक्सप्लेन इन वर्ड्स. तो वहाँ पे AMA सेशन काफ़ी लंबे 3-3 घंटे के AMA सेशंस होते हैं एवरी सेकेंड वीकेंड. यूट्यूब प्रो एंड यूट्यूब प्राइम पे है, उसमें मैंने एडिशनली कम्युनिटी पोस्ट इंक्लूड किया हुआ है जो कि 4 पोस्ट फॉर यूट्यूब प्रो मेंबर्स एंड 6 पोस्ट होते हैं यूट्यूब प्राइम मेंबर्स के लिए. सपोज मैंने टेक्नो इलेक्ट्रिक मैंने अप्रैल 2024 में जब डिटेल एनालिसिस किया था साधन प्राइम एंड प्रो के लिए, तो उसमें कोई भी अपडेट होता है मैं उनको अपडेट देता हूँ कि वट एवर वी थॉट ऑफ इज द कंपनी इज परफॉर्मिंग एज पर आवर थीसिस. तो उसमें आपको जो इन्वेस्टर हैं, अगर किसी ने वो स्टॉक खरीदा है तो उसको वो स्टॉक होल्ड करने की कैपेबिलिटी डेवलप हो जाती है. नॉलेज इज़ अ की एंड वी ट्राई टू डिसेमिनेट इट थ्रू कम्युनिटी पोस्ट ऑन यूट्यूब. वहीं प्रैक्टिशनर मेंबर के लिए तो टेलीग्राम पे ये लाइव मीडियम में जब भी मुझे कोई इंटरेस्टिंग लर्निंग मेरी लाइफ में होती है वो मैं शेयर करता हूँ, और कोई भी अपडेट होता है बिजनेस के बारे में वो जरूर मैं शेयर करता हूँ प्रैक्टिशनर मेंबर्स के साथ.
So, there are some foundational concepts in the market which, kind of, at least the way I have come to learn it. First foundational concept is you have to understand that there are 100 ways to make money from the market. Okay. So there are intraday traders, there are, swing traders, there are positional traders, there are growth investors, there are value investors, there are, venture capitalists. There are many ways to make money from the market, right? So the market, like I think it was that guy who wrote the famous book Trading in the Zone, right? So it's a very good book about market psychology, and he calls the market a river of opportunity, right? So just like a river where different people can utilize the water in a different way. Some people can use it for drinking, some people can use it for industrial use, some people can use it to travel from one place to another using a boat or something else. So similarly, the market gives you many ways to take money out of that river. Now, the problem comes like when I studied engineering, or when somebody studies medicine, or somebody studies commerce, right? There is a step-by-step course that you go through, right? So you get the foundations right, and then you go to the next, and then you go to the next, and then you specialize in something. right? But in market, what happens is because there is no proper, course, what people do is people randomly get introduced to the market, right? To the relatives or neighbors or uncle or friend or somebody, right? So they just get confused, right? And they try too many different things. So they will try to become an investor, forget about the process. They will not know whether they're an investor or a trader. They will not know, are they looking for growth or are they looking for value? They will really, be totally confused. They'll be doing too many things. And that is one of the biggest, reasons why investors do not effectively take advantage of the market. Just like religion, whatever religion you belong to, right? You have to choose one path, right? All paths, they may say lead to the same God, right? But you have to choose one path. Otherwise, you will be utterly confused. So similarly, in the market, you have to decide on one path. And one of the main ways in which you can decide on that path is you have to get your time frame right. You have to figure out, I have written about this also. You have to figure out what time frame am I operating on. That clarity has to come into play.
Yes.
Right? Clarity about the time frame. Now, am I playing the short-term game? Am I playing the medium-term game? Am I playing the long-term game? Right? So first you have to figure that out. In initial years, experimentation is okay, right? Because everybody goes through that. But at some point, unless you decide that, right, because that decision will then define, okay, what type of a strategy are you going to, go ahead and deploy in the market. The strategy will then define what type of a risk reward are you playing for? What will your gains look like and what will your losses look like? Like for, it will decide what type of stocks can you participate in. So once, you do that, then it is about the mastery of that process, right? Then it is about the smaller things, the nuances, when will the strategy work best? When should I scale up? When should I scale down? The higher order things. But the problem is people start from the top. They pick some strategy because somebody said something on Twitter or somebody said something on somewhere on YouTube. And they don't know the foundational aspect of that strategy. Where is it coming from? What time frame is it working on? One has to get this basic clarity around time frame first. What time frame am I investing in or what time frame am I trading in? Based on that will decide your strategy. Your strategy will decide your risk reward or profit and stop loss and all of that. Once you get that, once you freeze that, then you go about mastering the process of executing that strategy, mastering the nuances around that. So broadly, that is the life cycle that an investor has to really understand and incorporate to effectively make money from the market.
Many people have tested the water in 2020 June onward. Most likely they would have tested all kind of investment strategy, applied technicals, applied fundamentals. They might be thoroughly confused where to go about because sometimes technical gives us lots of return and sometimes fundamentals also have many multi-bagger stocks. In this chaos, what would be the way, what you would have done if you had just landed in 2020 in this stock market? What your approach would have been in 2024?
What direction you put or what paths you choose, right? It is a function of many things, right? It's a function of your own personality, right? Some people just can't, become traders, right? Some people just can't take that stress. Some people just can't become investors. They cannot imagine sitting with a position for 3 years, 5 years. They can't expose themselves to the market like that, right? And then it's a function of your lifestyle in the sense that what type of a job are you doing, right? So if you are actually working a full-time job and you want to be a trader, it's just not going to happen, right? Because trading demands a lot of energy and bandwidth, right? So your lifestyle is important, right? So you cannot do intraday trading or even swing trading and all of that if you're not full-time into it. Like I'm talking about somebody who wants to excel, right? Most people come with a mindset of, time pass kind of a mindset, right? They don't take it so seriously. So they take it, as in, okay, I'll try this. If it works, it works. If it doesn't work, I'll try something else. So that seriousness is not there. That is one of the main reasons why investors, are not able to, do the best opportunity that is out there.
Yeah.
So, like I said, your personality, your ability to take the drawdown, what type of a capital are you investing, right? So, is it patient capital? Is it capital that you can do away with for next 3 years, 5 years, 10 years, or is it some capital you've just taken out from your business and you put it into the market? So there are these 4 or 5 different things which will actually decide for you. Right, you cannot randomly say that I will do this or I will do that or I'll not do. So you have to analyze, right? What are my strengths, right? So where am I most effectively placed? if you're having a full-time job and if you don't have the time to develop the skill and expertise, and you cannot give a lot of time to it, then you're probably better off going to an investing kind of a path, where whenever you're free, a couple of hours a day, you do the reading and you learn some fundamental analysis or whatever, and you buy companies and you sit on them, right? Or if you can't even do that, you can't even spare a couple of hours a day, then you have to take the mutual fund route, right? So it's not about what is the best path generally out there, right? Somebody might be making 50% or 100% a year because they have those skill sets or they are giving that much time to it and all of that. So
Right.
that 100% a year is not your benchmark, right? You
Right.
have to benchmark, given what my strengths are, given what my constraints are, what is the best thing I can do. So
Right.
it's very dependent on an individual. So what I will do will not really be effective for somebody else. But they have to analyze it basis these 3 or 4 factors that I mentioned, like personality, your lifestyle, your ability to take the drawdown, and the type of capital that you are handling.
Okay. Wonderful. I'm a fellow investor, so I was really curious about your investment process. So whether do you follow a checklist kind of process, or it is more serendipitous in nature, or do you have a screener? So if you can elaborate on your overarching selection framework, maybe you might be having different strategy for different setup which you have. So if you can elaborate on these things, that how you pick up the stock.
Yeah, so I'll continue from the initial thought, right? So I decided that the time frame that I am going to invest in is going to be a medium-term time frame.
Okay.
So, I did some study and, based on, like I said, my personality and all of that, I don't want to be a very short-term investor. At the same time, I don't have the personality to, buy something now and wait for 3 to 5 years
Okay.
or 10 years for that to fructify. In some cases, I may wait that much, but broadly, I'm speaking at a portfolio level. On an average, I decided that I'm going to play a medium term. I want to be so on the medium term. I typically look at best performing stocks every 6 months, every 1 year, and try to go back and study them. What led to them. So typically, there is a re-rating that a stock undergoes whenever there is a big catalyst that comes into it, and typically this catalyst is the earnings. Right. So whenever there is a surprisingly good earnings, stock undergoes a re-rating.
Okay.
And that re-rating typically lasts anywhere between 4 to 6 quarters if you've gotten it right. If you've gotten it wrong, then in about 2, 3 quarters, you will come to know that it's not working out the way I expected. Some outlier stocks will continue to do well for 8, 12 quarters also, right? But mostly on an average, it will last between 4 to 6 quarters. So that kind of becomes my time frame that I focus on, right? So I decided that once I buy a stock, I will probably hold it anywhere between, on an average, 2 to 8 quarters, right? Because if I get it wrong, I'll know it in the second or third quarter. If I get it right, typically I might hold it for 6 to 8 quarters. So this time frame clarity I first developed, and the second clarity I got was, like I said, the idea that you need any big move typically has a catalyst. And
Right.
most of the time, the catalyst can be divided into 2 parts, right? So one is an earnings delivery catalyst, whereby very good earnings has been delivered, and that kind of a delivery is likely to continue for the next few quarters. And second is more of an anticipation kind of a catalyst, whereby because of some other news or some other event or something happening in the sector, the market is very sure that over the next 2, 3 quarters, the earnings are going to materially improve. Right? So market is a discounting machine, right? It discounts the future. It will not sometimes wait for the earnings to really deliver themselves. In a lot of cases, market will preempt, and because the market knows that the earnings are going to come. Right. A great example of this that I kind of participated in was BSC. Even before the earnings came, market had already rallied, right? Because the market already figured out that the options volumes are really going to change the P&L of this company, right? So if you see the results, the good results started flowing in, about 2, 3 quarters back, but the re-rating had started much before that, right? So these are the two main kinds of catalysts. There is a third kind of catalyst also, which typically, retail investors should avoid. It is more of a story, right? It is some sort of a theme or some story or some futuristic thing that this will happen, that will happen. Market, even in a bullish phase, right? The market even gets fancy to those things, and even those stocks do very well. So typically, if you study any big winner over the last, let's say, 6 months or 1 year, it will typically fall in these three categories. Either it's a theme or a story that is that something great will happen, or the market has anticipated that the earnings will improve in the next few quarters. Typically, a couple of quarters. The market doesn't look like really ahead. And if the earnings are going to improve 6 quarters online, the market will not re-rate it now. So the earnings have to improve over the next two quarters, 3 quarters. And then, of course, the earnings delivery, which is the simplest and often the best way to kind of play this. This is not something that I have discovered, right? So the PEAD phenomenon or the post
Yeah.
earnings announcement, it's a very well documented phenomenon. It's a structural tendency. It's been around for many decades. It works in the Indian market, in the US market, in all markets it will work. And that is why it's structural in nature. It is important that how do we incorporate this into our strategy and our process? Like I say, momentum is a structural tendency. People think that momentum is a strategy. Momentum is not a strategy. Momentum is a tendency.
Right.
How do you incorporate that momentum? There are 10 different ways of incorporating momentum into your strategy, right? Similarly, catalyst is one more structural tendency, and the earnings is a specific case of that catalyst. So I put these two things together, that I want to be a medium term investor, and I want to and this strategy kind of best suited my time frame, right? Because I realized that typically the earnings re-rating also is a medium term event. It is
Right.
not like a 5 year event,
Yeah.
right? It's a medium term event, and because I was operating on this time frame, it also allowed me to expand the size of my universe, right? So if I am a 10 or 20 year kind of an investor, right? If I'm a Warren Buffett type of an investor, then my universe shrinks a lot, because then I have to buy companies which I am sure will continue to do well 5 years, 10 years down the line. So a lot of companies actually go out of your universe,
Yeah.
right? If you are an intraday trader, on the other hand, the entire stock market is your
Is open.
universe, as long as the liquidity is there, right?
Right.
So again, here I felt that a lot of companies which people may think are shady, which people may think are not worthy, even they give you a 4 to 6 quarter opportunity. They may
Correct.
not have the best of the corporate governance, unless they're absolute frauds, right? In which case you don't really even look at them. It really expanded my universe. Earlier I was also very, private banks, consumption, quality. So I've gone through all those phases, right? So I've gone through. Then I realized that okay, if I do this, right, then I can actually bet on a lot more companies, right? So it even solidified my commitment to this particular strategy. Of course, I've converted that into a process, right? So it is not really any serendipity, and a serendipity is sometimes in terms of see, if you get 50 ideas in a quarter, right? Serendipity comes into play. You may pick, let's say, 20, 25 of them, right? So you leave 25 out. I don't want to have a very large portfolio of 7,500 stocks also. So even so, everything for me is like in the middle, right? So even the
Okay.
portfolio size, one point I used to own just one stock in the portfolio.
Oh.
When I was managing for myself and all that. Of course, you can't do that with public money.
Right.
But now I've realized that a number between 20 to 30 is kind of a sweet spot, right? You don't want to go to 70, 100 companies, but anywhere between, let's say, 25 to 35 companies is a sweet spot, which gives you enough protection if a single idea goes wrong, right? It doesn't kill you.
Right.
At the same time, it allows for serendipity, right? Because when you pick 35 companies, typically you'll pick one or two companies which will turn out to do exceedingly well, right? You might not have thought that they'll do the best, but they will end up doing the best. So a diversified portfolio like this, about 20, 30 stocks, allows you to give space for more ideas. That is where serendipity kind of comes. But otherwise, it's a very process-oriented strategy whereby we look at almost all the 1,500 results that come out, and we have different ways of rating them, classifying them, and all of that. And then from that classification, from that filtration, we look at where we should go out and allocate.
You spoke about that you have now focused more on a kind of a earning surprise kind of setup. But parallelly, you also spoke about how you had been at one point of time concentrated investor and then a quality focused investor was a part of the journey. So do you still have a kind of portfolio which is where you are invested into, let's say for 20% or for a smaller allocation into quality names?
No, not really. No, because I don't see, that's what I'm saying. No, so I don't like to mix too many things, right?
No.
See, you need to, in anything, right? Whether it is in business, whether it is in the markets, you have to focus, right? If you want to master something, then you have to focus. And if you start diluting your energies, right? Like the same thought continues, right? With people who think that, okay, I'll do this also. I will also be a trader. With some capital, I'll also do SME. With some capital, I'll do quality. With some capital, it might work for some people who can devote time to all of that. But for me, I think what works best, like I said, is to choose one path and kind of fully commit to it. And because that is where your all your attention is, right? So attention
Okay.
is money, right? So
Yeah.
if you say that 20% I'll do quality, but why should I do quality if this strategy I feel will outperform? Because quality typically is suitable for some specific type of investors. Like why does Warren Buffett do quality? You have to understand.
Mhm.
He doesn't do quality because he wants to do quality. I mean, he himself said that if he had just $1 million now, right, he
Mhm.
would go completely into all the the
Small
value
caps.
stocks or the unknown stocks and all small caps and all of that,
Right.
right?
Mm.
He does quality because he is playing on float, right? He's immensely leveraged, right? In the
Right.
sense that he's playing on the insurance float money, right?
Right.
So he cannot afford to take risks with that money. Forget about the size of the capital is one issue he
Mm.
has, but even if you ignore that, the reason why he's been doing quality for the last 20 or 25 years is, he realized that a large amount of capital I have to deploy and I have to deploy it with a lot of safety.
Right.
That is where you go for quality. Now, for a retail investor who cannot focus on the market, or,
Mm.
like I said, the lifestyle doesn't allow
Now to.
time, then for him it makes sense to do Asian Paints and, Lever and HDFC Bank and all of that. It makes sense. But if you're an investor who's giving time to the markets and,
Mhm.
you're willing to learn, then having a 20%, 30% in the quality portfolio doesn't make really any sense across the cycle. There might be bearish phases where some may come and argue that, because I was quality, I fell less. But what you have to realize is, see, if you have a full portfolio of quality, and I'm not against quality, I'm just making an argument here.
Mhm.
Sure, if you have a 100% portfolio of quality, right? So what will typically happen is the portfolio in a good market may go up by 30%, and when the bear market comes, the return might come to 15%, right?
Right.
But if you have a slightly mid and small capish portfolio, then what will happen is it will go up 70% and
Mhm.
it will come back. Let's say it cuts by 50%, it comes to 35%. So
Mhm.
net net, you're still better off because you're making
Right.
35% on your money here and 15% on your money here. You might say that, it's more volatile. It fell 50% from the top, right? Whereas this fell just about 10-15%. But
Right.
those are the clarities one needs to have, right? So what am I exactly doing? Not randomly go into quality, or you have to realize what is my goal, what type of capital do I have, how
Okay.
much time can I devote. So all of those things have to then translate into your strategy and not the other way around, right? You can't just pick a random strategy and then make it work. It doesn't work like that.
Okay. Understood. So just to summarize for my audience, that quality is something could be a function of lifestyle. If somebody wants to get into limited names who doesn't
Correct.
fall much, actually drawdowns are very less. For them, quality makes sense. But people with time and attention in market, they should go for companies who are working towards increasing their earning potentials, entering into new markets. So
Correct.
as an investor, we all look at numbers, but beyond numbers, if I have to ask you, what are three important parameters which you look into? It could be management, it could be a TAM, or it could be anything. I'm not represented number, not reported number. I'm talking about anything beyond reported number, which matters most for you.
Of course, the management and all of those things are there,
Mhm.
but I don't think good management necessarily translates into good returns. Over the very long term, yes. But like I said, I again come back to my time frame, right? So on my time frame, management, doesn't really, like I said, right? Because it's a spectrum, right? Of course, I don't want to be with any fraud management,
Mhm.
right? But a lot of times, the biggest money is made when the management perception changes or when the management itself changes. So when I say management, I don't mean invest in something which is like a blue chip type of management. What
Mhm.
I mean is when the management perception changes, when the management itself changes, that is where the big opportunities are. Even
Okay.
if you study the returns, like why did CG Power do so well? Right?
Mhm.
Because it went from a fraud management to a gold standard management.
Right.
Right? That was the only trigger. There was no other trigger. And everything else was incident. So when I say management, it is that. But I am not a fan of static in a static manner evaluating management or business quality,
Mhm.
right? Because money is made when there is a change.
Change.
Money is made in the delta. The money is in the delta. The money is not. You get a pristine management like the Lever or Asian Paints, some of these guys, right? Not necessarily you will make money. The best amount of money, right? You still do well, you'll still probably beat Nifty. And you may, but I am talking from an active investor point of view here, right? So
Right.
like you pointed out earlier, if you're a passive investor, it's a completely different game. You can just go to mutual funds or you can buy a few blue chips and
Mhm.
sit on them and you'll do reasonably well. But
Right.
I'm talking for an active investor, right? So
Right.
so other than the management and the business quality, in these two also I look for the delta. For whatever reason there is a change in the business. If there is something happening in that company or something happening in that sector,
Mhm.
which can kind of change the trajectory of the companies. That is what I'm looking at, and even the management, right? If the management's view of the business or the management, the way they are running, maybe the next generation has come in and they are
Mhm.
more hungry for growth.
Okay.
So those are the things I'm looking for. But other than that, I would say there are two factors which qualitative factors which
Mhm.
one has to really look for, which is one is the overall market, right? The market
Right.
environment is something that is very important even for an investor, right?
Mhm.
Because if the market environment is good, then the way your strategy will behave will be dramatically different than if the market environment is bad. And it's true for most strategies. Right? So people have a static way of approaching markets in all market environments. They feel that there
Right.
is some one formula, but that formula has to completely change if the market environment changes. Understanding the market environment and the market context has to be one of the biggest things that an investor has to learn, because more often than not, almost 70% of your gains will be a function of the market environment and not your
Mhm.
strategy. Right?
Right.
If you just figured out 2020 post the COVID that liquidity is like crazy and the US is printing like crazy, if you just got that bit right, it really didn't matter
Mhm.
where you invested. You
Very
would have still done stupendously well. And
right.
and when the market turns also, right? When the regime changes, if
Mhm.
you don't understand that, right,
Right.
then you can get really caught on the wrong foot. Not that anyone, including myself, can do it perfectly, but
Mhm.
that thought process has to be there, that the importance has to be given to the market environment, because that is what drives a large percentage of the returns. And the second is the idea of giving importance to sectoral, moves,
Yes.
right? So the biggest gains are typically happen when there are sectoral trends, right? So like 1999 was about IT, and then 2007 was about infrastructure and real estate, and then after that was some consumption, and then it was private banks and NBFCs, and
Mhm.
then post COVID it was a lot of API, pharma, and
Mhm.
now it was like defense and railways and all of that, right? So if you get the sector right, that is again like I said, if 70% is market, and this is not my quote, right? It was documented. 70% is market, about whatever 20% is sector, and only 10% is your stock. People give 90% or 99% energy to stock selection, and
Mhm.
they don't really bother about the market environment and the sector selection. So
Okay.
I would say these are the qualitative, things one has to keep in mind. And like I said earlier, you have to be more focused on the delta in the
Mhm.
markets and not on the absolutes.
I talk about this in my mentorship class that market is a place where you are participating in a Kinesian beauty contest, that who you think would look better
Correct.
to others, not to me. Hard coding it and straight jacketing it as a quality franchise or something like that can work against oneself.
Correct.
So,
Correct.
in terms of perception of quality in management, if you have any tools to figure out that the perception of a quality is changing. For example, I hear lots of stories in hindsight. Like, for example, I'm just giving even though I don't own this company, like KPR Mills, that was a case where the management perception changed, right? So if you're familiar with the story, how do you proceed in such cases where management in a, let's say, in not so hot sector, like say textile is not a something which any value investor or typically is not a preferred sector, where somebody is doing amazing job, let's say, and how you would go about finding those management, because one of the tools you spoke about is the delta in the management perception. CG Power was an example which is rightly taken, but can we make a mental model out of what you just said, if you can explain with an example?
See, the management quality typically comes only from experience, right? Like you said, you heard some story about KPR Mills or you read about some company. What is the management? It is purely a function of how long have you been exposed to the market. Like if a new guy who just lands into the market in 2024 will really have no clue about, other than the top level, like, the Tatas are good and Reliance is okay and, somebody else is, but that is a but larger, picture, if you look at, it is really a function of experience of how these managements have behaved in the past, how much value have they created, what decisions they have taken. So that is one of the strengths, that any large professionally managed, like investment management firm has that experience, that bank of knowledge, right? So, like I said, I'm the youngest of the three partners, and my other two partners have been in the market for much longer. So they have that mental database, in terms of which management, what has the Birla Group done, or what's typically their modus operandi, or what somebody else has not done, right? So it is really a function of how much exposure you have to the market. Now, having been spent in the market about 20 odd years in the market, uh, that knowledge bank has built up for me also, right? So when I look at a company, if it's a company which is listed for a while, obviously, I can, very quickly figure out that, okay, so I know their history, and, if this company has come up with very good numbers, I might bet a little bit more, because I know that these guys will deliver in the last cycle, they delivered. So that's that kind of a thing. But the important thing is when the perception changes, right? Which happens in the present. So what I've spoken about is what these guys have done in the past.
Right.
But when the perception changes, right, that is when you have to act, right? Now, if somebody who was thought to be a good management or an average management suddenly start doing something shady,
Right.
then you have to get out. And there are no questions asked. Sometimes during a bullish phase, the stock may continue to do well even after that. And it's a personal call that people have to take, or at least you have to be on the edge. At least you have to be ready to exit if you're not willing to exit completely. But the moment people, start doing, crazy stuff, to give you some examples, what's happening now, a lot of companies did IPO dressing, right? So just
Right.
before they come for IPO, they will, increase the, top line margin, all of that. And suddenly post IPO, you see the results just to fall off a cliff, right?
Right.
So that is a red flag that you remember. That doesn't mean you don't participate in them, but, unless they've done some, like I said, major fraud, but you have to remember that, okay, these guys are not 100%, right? There's a lot of gray in here, right? Similarly, doing QIPs, right? So some managements, just because the market is good and they don't even need the money, they're doing QIPs.
Right.
So those things kind of tell you, or doing back-to-back QIP. You just did a QIP last quarter, so you should have planned, right? Now, why do you need to do a QIP again 3 months later, right? So unless you've got like a very big order and you need working capital, QIP is a major event, right? You are actually
Right.
raising money, right? You're giving out equity and you're raising money. Now, if you did a QIP 3 months back, and just after 3 months again you're doing a QIP, you're just being opportunistic.
Right.
You're just playing the market. So you have to be on the lookout for these kind of actions by the management, and it has to go into your knowledge bank, right? And so then you will know, okay, doesn't mean that I ignore those companies, but you have to know that, okay, you have to be a bit careful here.
Careful.
Or these are so-called bull market stocks, right? A lot of bull market stocks.
Right.
Stocks which will only do well in this bull market.
Mm.
And by the time the cycle ends, right, those stocks then they will not be seen for years together
Right.
in terms of, right? So you have to have that clarity of thought. And, that is what I mentioned a few days back in a tweet about SME also, right? It's not
Yeah.
wrong about going into SMEs, but you have to know that you're playing with fire. You have to know that these are managements, unless you have feet on the street, you know the management personally, right? Which most retail investors don't, right? There may be some who are doing the legwork and they really, do all of that. But most people are, jumping on somebody else's back and doing these investments, which have done phenomenally well. But you have to also know that, okay, you are playing a game where there is a big possibility of, a lot of loss. At the same time, you've made money also, but you have to have the clarity of thought that, okay, the managements I'm dealing with, right, they're all very small companies. They have no track record. Maybe this is their first cycle. They have not seen multiple cycles. They have not seen a difficult business environment. You don't know how they will behave or what they will do, in a difficult economic environment. So that is how you have to kind of judge the management. Most management, by default, you have to consider them as average. You should not give them any extra, unless they have done something, extraordinarily well for you to think that they're very good. And a lot of times, if you read con calls, the way they talk about their business also gives you a lot of sense about what type of a management is it,
Can
what
you
their focus.
can you elaborate on this point? That would be really helpful. How you read concall or from that perspective?
See, in concalls, I'm just looking for a few very key points. I don't really care about what has happened in the past. Telling this specific to the kind of investing that I do, right? Like I said. So I'm interested in the medium term. So I want to know what is this company going to do over the next few quarters, right? So typically when I'm reading it from that frame of mind, I am reading it with only that question in mind. I want to know what is going to be the revenue, what is going to be the margin. A lot of times these are not told in numbers. They are
Okay.
indicative.
Mhm.
They are told using adjectives. They are told using different forms of the English language, right? So
Yeah.
you have to read between the lines, and that is the part which I really enjoy, right? Trying to
Yeah.
figure out AI and all cannot do, right? And we even experimented with that.
Okay.
So positive tone, negative tone, all those things,
Mhm.
the AI can't give you that feel.
Right.
So when I read what the management is saying, right, you can kind of get a feel behind what they are talking about in a lot of cases, right? So it's sometimes they'll give you the bare numbers that we expect to grow at 30%, 50% for the next 2-3 quarters or next 2-3 years. They'll give you a proper guidance, but a lot of cases they will use certain words, they'll use certain phrases which will tell you that the company has a lot of opportunities going ahead, but they'll explicitly not talk about it. Right. So
Okay.
when I'm seeing it from the earnings strategy point of view, then I'm only looking at those kind of I'm reading with a focus to find out those things. But sometimes you read con calls even at leisure, right? You just
Right.
want to know about a company,
Yeah.
and that is when I kind of pick up these other nuances around
Okay.
what the management thinks. How is the management thinking? Are they long term in nature? A lot of management they don't really bother about quarter on quarter. They're very focused on their business. If you even if you read the old HDFC Bank on calls or the Bajaj Finance on calls, you can see that clarity of thought. They are very focused. Bajaj Finance is very clear that we want to grow and we want to keep our credit cost between this X number, right? That is what they work towards.
Right.
That is what that goal is very, very clear, right? So even in the worst of the scenarios, you know that okay, that these guys wants to work. The same thing if you read some random microfinance company, the way they talk and the way Bajaj Finance talks, right? You can see that difference in the way they
Right.
convey about their business. So
Yeah.
these things give you a lot of idea about the management.
Correct. Just to summarize, you have given us a very good model to operate on that. By contrast, that if you see a market leader and you see a novice where you might be interested. So if we contrast each other to management and how they are looking at guidances or how they are looking at the same ecosystem, which may be financing in case of Bajaj Finance. So that can give us an approach that how to really look at how management is thinking is a long term or a short term.
And just to complete the thought, right? It doesn't mean that this the noise company actually from a 1 year point of view, 2 years point of view might outperform Bajaj Finance, right? But it's important to have that clarity at the back of your mind that I'm dealing with somebody who is mediocre in terms of management. So I cannot give this guy too many chances, right? If the business environment changes, then I have to just exit. Whereas in a Bajaj Finance, even if a business environment changes, I can still sit on it. But that doesn't mean that you discard the noise company. The noise company may actually make you more money, right?
Right.
So we have to be pure capitalists in market, right? Because money, like they say, right, that has no color. It doesn't matter whether you made money from Bajaj Finance or from some noise company.
Right.
But it's important for you to make the decision making right. You have to have the clarity that okay, this company is not so great. It's just having a good tailwind right now. So I have to allocate appropriately, and I cannot give it too many chances in terms of business performance start deteriorating, or there is some news which tells me that this company, this sector may not do as well, or the growth is going down. Then you cannot stick there. You have to get out.
One question which was just lingering in my mind is that how important TAM is for you, because you talked about themes and sectors, tailwinds. Sometimes the TAM expands in certain sectors. How you go about hunting into those sectors?
Basically, because I try to play for this, like I said, right, 6 to 8 for the kind of a thing. The TAM, in an absolute sense, is not very important, but it always helps if you are in a sector where the TAM is big or the TAM itself is expanding, right? So one of the big winners over the last 2 3 years for us and for the rest of the market also has been the power sector, right?
Right.
So all the power ancillaries, right? Whether it is distribution, transformers, everything. So we invested because we started seeing growth there and started seeing the tailwinds, and you read the con calls, you realize that this growth is here to stay and all of that. It just helped that because the TAM was there. Some of those power names, like I said, typically I might hold for 6 to 8 quarters, but some of those power names you have been holding for maybe about 3 4 years now, right? So maybe 12 quarters or 15 quarters because the TAM is expanding, the growth rates are continuing beyond that typical 4 to 6 quarter range. Otherwise, what typically happens is you have a great quarter, and then you have 4 quarters after that, and then when you reach the fifth quarter, your first quarter becomes
Quarter
a high
base.
base.
High base, right.
It becomes a high base, right? But if the TAM is expanding, then the fifth quarter can again beat that first high base quarter, right? So that is why TAM really comes into play. It's not critical to the strategy, but yeah, if it is there, then one would obviously prefer higher TAM. But the first criteria is not TAM. The first criteria is growth. I want to see an earnings growth. Then, if that earnings growth is happening in the context of expanding TAM, then it becomes one more variable to kind of play with to allow even if you have a large TAM in my strategy, right? So then I might give a couple of quarters of slowdown in the growth I can ignore because I know that there's a much bigger opportunity out there. Right? It's kind of happening with some companies now, like some power companies, which a couple of quarters have been okay, a bit subdued. But I know that the story is not over, right? There's still more to go. So you can give them that much leeway if there is a high time. If there is not much of a high time, then you kind of exit them, if you feel that the growth is slowing down.
Okay. How you go about allocation strategy? Do you have rules like I will not go beyond 20% or what? Since you spoke about 25 30 stocks, so typically how do you position size into those 25 names?
No, I go with equal. So it's about
Okay.
3 to 4%, in each stocks. Because like I said, right, I want serendipity to play that role.
Right.
I don't know which stock. See, allocation becomes important in a quality kind of a portfolio where you have very high conviction about the management, and you can bet a lot more there. But in the kind of thing that we are doing, right, it's fairly active in nature. We intend to, the best case, intend to participate in a re-rating and get out after 6 to 8 quarters, right? So
Okay.
so in that sense, having a very differentiated allocation doesn't make sense. But the way I play that allocation game is through having more stocks of that sector, rather than buying a higher allocation of one stock. Let's say I was bullish on defense, I was bullish on railways. Then instead of having one stock, I might have 3 4 stocks of that sector, right? So to play different flavors at the same time, get a flavor of concentration, but not through one stock. Get it through multiple stocks.
Multiple stocks. We talked a lot about how to make positions and how to really go about allocating. What differentiates a man from boys is exit strategy. So what are the scenarios when you exit?
Like you said, correctly said, exit is the most important part of any strategy, and it is often the most difficult because there's always this element of regret, right? Because post exit, typically, you will see that the stock that you have sold continues to go up. Once we exit the stock, right, that calculation nobody does of whether the new stock that I've bought has it outperformed the one I've exited or not. Because the exit the stock goes out of your portfolio, it goes out of your accounting system. So nobody really does that measurement. Even I have not done it, but so typically it looks like regret, but actually you don't know whether your new stock has done better, or maybe in one particular case you will know, but at a portfolio level, for multiple exits and multiple entries, you will not really know whether you are better off holding something, or you're better off selling that, right? So selling is always difficult because that FOMO, or that those thoughts come in mind that if I sell this, it continues to go up, right? Then so it's a psychological game, which is why I mentioned again the idea of if you have clarity of thought around your strategy, then exit becomes very easy. Right? Most people struggle with exit because they don't really have a strategy in the first place. Right? They're randomly investing. Like I said, they don't have a clarity on time frame. They don't have a clarity on what type of a returns are they playing for. Right? So typically, if you are a very long-term investor, then you're playing for a multi-value. You are looking for something that will go up 2x, 5x, 10x, right? So in that case, you can't really have an exit strategy, right? You're just letting the stock run, right?
Right.
You might exit, after 5 years, after 10 years, when maybe when the market cap has reached a level from where you feel that this cannot go up another 5x, right? So for a long-term investor, the exit strategy is something like that. Maybe you're looking at the terminal value,
Right.
right? So you're looking at okay, if the stock has already become 1 lakh crore in market cap, what's the probability that it will go up another 5x or 10x, and then you exit it, right? So similarly, for an intraday guy on the other side of the spectrum, right, the exit strategy is very, he has a time by before 3:30 he has to exit because he's leveraged, right? So he will have some time-based exit strategy, or he'll have a small profit and a small loss, stop loss kind of an exit-based strategy. So exit strategy again is a function of your risk reward.
Right.
Exit strategy is a function of what kind of a reward are you playing for, right? So if you are playing for a very large reward, then you will have a very different exit strategy versus if you are playing for a small reward, right? So now in my case, it's very clear, right? So in my case, I am betting on earnings, right? I'm betting on
Right.
earnings growth. So I have a couple of exit conditions, right? So one is if I bought something and I thought it will really do well next few quarters, 2-3 quarters, and it has two back-to-back not satisfactory quarters, right? I will exit it,
Okay.
right? One quarter, typically, you will give it room because sometimes there are different reasons why a company may stall for a quarter. But if there are two
Right.
back-to-back quarters of, and that has its, downside in terms of the market also, the stock will be down 20-25%
Yeah.
sometimes, right? You can't help it. You should be clear why you are buying, right? So when you're clear why you're buying, automatically you will know why you're selling, right?
Right.
So I am buying in anticipation of
Growth.
very good quarters back to back. If
Right.
the quarters don't come in, then I have to exit no matter what. And the second, like I said, is if the story has played out for about 5-6 quarters and it's become something that is mainstream, and I don't think the TAM is very large, like our earlier discussion.
Yeah.
And I feel that, okay, it's played out, and now, like, because of the turnaround, it was going at 50%, but now the high base will catch up and it will only grow at 10%, and there's not much left here, then I will exit, right?
Okay.
Also, if the stock goes euphoric, I might do partial exits, right? If a stock that I bought, it again delivers blockbuster earnings and the stock just goes up 40-50% in a week, then I might take some off the table. I might take some partial profits. Again, so it's very specific to my strategy. So, and so that there are no perfect exits, right? So there'll always be mistakes, right? So a lot of times, a company announces a very good quarter. 2 quarters, it's subdued. I exit. Then the very next quarter becomes a blockbuster, right?
Okay.
And you not only have and by the time the next quarter results come, the market would get a whiff of it. The stock would again be back near the highs. You've already lost that 25% which it had fallen. And from there, it delivers a blockbuster quarter and it goes up another 25-30% from there. So you've lost like 50%. That's part of the game, right? So we cannot analyze because we have to decide without the benefit of hindsight, right? So you have to take the good and bad of it. A lot of times your exit decision will be right. A lot of times it will be wrong. It is this tendency or the need that people have that I want the perfect selling strategy, a perfect formula to sell. It just doesn't exist. It doesn't exist. So you have to be true to your strategy, right? So like I said, if you are clear why you have bought, you also have to be clear when are you going to sell. So depending on what strategy a person is running, what kind of allocations they are running, so I can afford to take a 20-25% hit if my thesis goes wrong because my allocations are about 3%. So right, so 3% means at the portfolio level I'm probably losing 0.75% if I lose
Correct.
25%, right? If somebody is betting 20% of his portfolio in one stock, then he cannot take these kind of drawdowns. Then he has to have a different exit mechanism. The exit mechanism is also a function of your allocation.
Right.
So I am saying that I am okay to, on an average lose anywhere between 15 to 25% on a stock because on the upside, I want to make 50 to 100%. So I have that risk reward, so a 20% downside on an average, and let's say 60% upside or 50% upside. So I have a 1:2, 1:3 kind of a risk reward ratio.
Okay.
So, but if a guy, is allocating 20% in one stock,
Mhm.
and that stock falls by 25%, and on the upside, if he's not able to, in some other stock in his portfolio, if he's not able to make that much, then
Mhm.
he's completely, and that is why the diversification allows me, because let's say you lose 25% on a couple of stocks. If
Mhm.
three or four other stocks give you 50% return or 30% return also, you're
Mhm.
still done with.
Still done.
But here, with a 20% allocation, you only have five stocks. So
Right.
the moment one stock goes wrong,
Goes on, yeah,
your hit rate has to really go through the roof
really.
for you to succeed, right? So these are the smaller things which people have. Portfolio construction, your strategy decides what kind of a strategy you're running. That decides your selling decision. Your allocation decides your selling decision. Your portfolio construction decides your selling decision. So all
Mhm.
of these things have to come into synergy to come up with a sell, right? So if you're a trader, traders typically trade with leverage. Why
Right.
do traders use stop loss? Because they cannot afford to lose. They have to get the timing perfect. If you're an investor, you don't need to have a perfect timing. You can allow the stock to, not go anywhere, or come back a little bit, 10%, 15%, and then take off. You have that, leeway. If you're a trader, because you're betting a lot of money on each trade, sometimes you're even leveraged. You
Mhm.
cannot afford to get the timing wrong. The stock has to take off right from the word go, right?
Mhm.
Otherwise, you are losing like 2-3% of your portfolio. You lose in one day, and if there are a few bad days, before you know, you'll be down 20-25% of your capital, right?
Oh,
So it's very much selling is something which people have to correlate to their allocations, to their entry criteria, and also to the portfolio construction.
that's wonderful point, and it actually answers both type trader and
Yeah.
investor alike. That's amazing, sir. Just one question I have on in terms of since we talk about trader, so do you have any technical setup as well, backing your fundamental setup?
No, I don't use technicals in the way typically technical indicators and all I do not use.
Okay.
But I always have an eye on price action. Like I said, where is so typically momentum, like I said, but I use momentum as a scan also. So
No.
where is the momentum in the market, right? It
Mm.
also tells you where the action is. So a lot of times you cannot do all the research, right? Sometimes you have to
Mm.
let the market also do the research for you,
Yeah.
right? So momentum is one of the ways, right? And it has to be a early momentum, not late momentum. So some stock which has been going up for year, 1 year, 2 years will not help you. But let's say a stock has just started a rally over the last 1 month or 3 months.
Mm.
And so if you keep looking at those winners over the last 1 or 3 months, you will get some sense of where the action is in the market. And then you have to go back and think, okay, what is happening here? Are the earnings good? Is it something that I missed? In
Mhm.
terms of the earnings, or is there some other catalyst there, or is there some other story playing out? So technicals, I use price action in this sense, in terms of a scan
No.
to figure out if I am missing something that is happening in the market, right? And also to
Mm.
get a pulse of the market, right?
Mhm.
Like I spoke about market environment earlier, right? So to get a sense of the broader market, also you have to use price action, right? In terms of the breadth of the market, how many stocks are doing well, how many stocks are not doing well, right? If the entire market is doing well and your portfolio is not doing well, then it's a question mark. The
Mhm.
entire market is kind of choppy, like it has been in the last, although Nifty is at all-time highs and Bank Nifty also has caught up now. But the broader market is still, chopping there. If you look at the mid-cap index, small-cap index, they have not really broken off from the highs, right?
Mhm.
So it tells you that the market has gone into a bit of a chop. If you look
Mhm.
at the breadth also, it's about 50%, right? So those things give you an idea of what is happening in the market right now, or what season are we in.
Okay. I mean, I would like to have one first-hand account of one of your biggest success, which if you would like to share with us.
So we've had a lot of big winners in the last 2-3 years,
Yes.
right? I think one of the most satisfying one, I think, was Apar Industries, right?
Mhm.
So we picked up this stock purely based on the earnings, right? If you go back and look, it was very clearly that there was a change in the nature or the growth of earnings that were coming in. And that is when the stock was kind of picked up.
Yeah.
And then I went back and read the con call. And if you read the con call, I think about 8, 9, maybe 10 quarters back,
Mm.
management was extremely, bullish in terms
Bullish.
of the opportunities, not only in power segment, but they were, talking about power, railways, everywhere they had some or the other business opportunity,
Yeah.
right? And the valuations, everything kind of came together, right? So APAR is a very good example of, company that was really not going anywhere, was trading at about 10, 15 P, starts growing fast, right? You have valuations in your favor. You have a fairly decent management. You have opportunities across multiple segments, each of which has a large TAM, right? So whether it was railways, whether it was power, within power, they're into multiple things, like they're into transformer oils, they're into cables. So everywhere, there was an opportunity. And, generally you had a good market environment also, over the last 2 years. So it was like a perfect stock, everything coming together in your favor. Sometimes you get very high growth, but the valuations are already so high that you really are confused. But here, the valuations were cheap, right? 15 P, I think it was. Earnings were growing at about 30-35%,
Yeah.
or more. The opportunity to grow over the next several quarters was very clear. And generally, the theme was coming into favor. At that point in time, it was not really well known. It was neglected. Nobody was talking about power. But it was very clear that the entire sector, right, Power, Voltam, Shilchar, CG Power, ABB, everything was coming into play. You had a good market environment. So it was like a perfect stock, right? Everything coming together. And the stock did massively well. I think went up, 10, 15 times from those levels. So it's very rare, right? You get those kind of an opportunity, especially in this market. You will not get any such opportunities because everything is, more or less fairly valued, right?
Yeah.
So only the laggards or the stock which have not participated yet, you will, with a lot of difficulty, you will find something below, 15 or 20 P. Only regret is that when everything comes together, you have to bet big. But we had a process, right? So I had a process. We did well. I mean, other stocks also did very well. So I stuck to that 3-4% allocation. But one of the nuances is that, if you're an individual investor, when everything ticks off, then you have to take a slightly larger bet. Now, for us, when we're managing public money, we have to keep all of those checks and balances in place. We have to follow a process because in the long run, the process, really helps you because I might find one apart, but if I got it wrong and allocated big, then the hit also is quite bad, right? So because when you're buying it, you don't really know whether it will succeed or not, right? So it's only later that you come to know. But when everything checks off, right? Valuation, growth, company management, sector, overall market, and everything checks off. Typically, it's a good idea to bump up the allocation a bit.
That's the end game. I think that you have kept for yourself. It looks like. Yeah, wonderful.
For the next cycle or next opportunity to come, if you keep jumping, then you will not master any strategy.
That's amazing points. So sticking to the core principle.
Sticking to one thing. Any one thing. You could be a trader, nothing wrong. Like you could be an options trader, no problem. But problem is people do it with a half-hearted. If you want to become an options trader, you want to become an investor, go completely deep into it, right? You have to go deep into one thing. You might be a quality investor, but go deep into it. Understand how quality investing works. Study how the quality stocks have performed. Look at their price action. Look at their earnings. Look at their balance sheet. Look at how quality stocks have done in the US. Look at how quality stocks are done in India. So you have to become an expert in quality stocks. Then you will know, every move of the quality stocks will be able to make sense of. So you have to pick one. Otherwise, your energies, if you dissipate across multiple strategies, you will have average results. You will not be able to, in fact, you'll have below average results because, after all the mistakes and this and that, and any which way the market is not an easy game, right? It's a psychologically very challenging game, right? It plays on your psychology. Market is designed to play on your psychology. So if you don't have a clarity of thought around one strategy, the market will easily fool you.
I keep reading your blog and you talk about certain stocks and you name a couple of them. You list out that these are on your radar right now. Last we have on 31st August you mentioned, and then right now we are sitting in September. So what is on your radar if you have to write a blog?
Typically, if you observe, I do it post an earnings season, right?
Yeah, post an earnings.
So I think the next earnings season is it's about to start. Actively looking forward to it. So I think whatever I liked in the last earnings season, a partial list, I just put it out. And it's not that it's on my radar. It is more that, those are the kind of stocks which people should look at because of their last quarter's earnings, right? Then you have to go back and see, okay, why did I put those stocks there? What was there in the earnings that kind of made me, put them there? So now we have to see what Q2 brings, right? Hopefully it will be better than Q1. Q2, Q3 are likely to be quite good. Q1 generally is a seasonally weak quarter. Q2, Q3 should be good. Hopefully, markets also continue the way they are.
If I talk about one sector, not one sector, but let's say infrastructure versus consumer versus defensive or something like that, or manufacturing. So where you would like to see yourself hunting more in this Q2, let's say?
No, that's the beauty of it, right? So that's the beauty of it, because I don't preempt. See, like I keep telling my investors also, I myself don't know what the portfolio will look like 6 months down the line, because it's purely a function of what data comes out from the earnings, right? So I don't know. I really don't know which stocks I will own, which stocks I'll exit. It's purely a function of what data they put out. So it's like I said, when I picked up APAR, I did not have any great insight about the power sector or some macro about the power. It was a very bottoms up pick, and I saw multiple power companies coming in that earnings season, right? Because APAR was there, I think Voltamp was there, some names like Shelchar and all of that, right? So all of them kind of were together. So you get a sense that, okay, something is probably happening here. So it works like that. So it's not like before the quarter I will decide that, okay, this quarter I'm going to focus on, right? And actually, if you feel like that this is the quarter I want to focus on, I think then you are near the top of the sector, So you have to really let the earnings, do the talking, and then independently think, that okay, like power now is a fairly, it's no longer a neglected sector. It's a fairly known, right? It's a fairly known thing now. So you can't expect the re-ratings have happened. So they'll continue to do well, but you can't expect any fireworks, right? In terms of
since you own a basket of, let's say, APAR plus 3 more. So how you do decide on all these power sector stock to say goodbye to? I mean, because I think they all will kind of taper down together.
Like I said, earnings. Like I said, if I feel that either the earnings growth slows down, or there is some sort of a news flow which tells me that this is over, the story is over. But that has not happened yet. In fact, I think there is some policy to be announced tomorrow or this week, also some electricity power policy. So I think there is a lot of this AI driven demand. So those narratives are still there. So I think power is something where few more quarters of growth and buying and all that will be there, right? So but what I'm ideally looking for is, I'm no longer looking for power and defense and all that, because they are discovered themes,
right?
So you bought them, so you're just riding them now. You have to figure out when to exit them. But what I'm looking for is something that is new, something that is neglected, something which is the APAR of 12 quarters back, which nobody's talking about, but the numbers are coming, right? So that is what you want to look at. That is where the next alpha is going to be. Alpha won't be in power and defense and railways.
But if you are excluding SME stock from your universe, very few new sectors you would get to see, because
you will get. See, if you are to build a portfolio of 25, 35 companies, and every quarter typically I buy about 7-8 companies, right? So about a 20% churn is there. 7-8 companies you can find. 7-8 companies is not a big deal. If you're thinking from your portfolio point of view, forget about the market. 7-8 companies you can always find. And consumption is, I think, really picking up, right? Consumption is one sector I'm looking forward to. Textile is one sector, which might turn around. Some of the consumer durable results were also quite good, right? So if that continues, right, going into the festival season and all that, so it need not be some totally new sector like defense and all work. It can be existing sector which is coming out of their old cycles, and a new thing is beginning, right? Like consumption was down in the dumps, private banks were down in the dumps. Now they are starting a new leg maybe. So it need not be a completely new category or new sector. It sometimes is an old sector, or maybe it is the private banks or the NBFCs or the consumption, whatever was not doing well last 3-4 years, maybe they will start doing well again. You have to keep an open mind. That's the key thing about this strategy. And, once the results start flowing in, then you have to figure out, what needs to go out and what needs to come in.
Amazing. Thank you for giving so much detailed and so much insight about investing and with mixing it with your personal experience and sharing with the larger audience with all the details and nuances of investing. That's had been an amazing learning session for me, and I'm sure my audience would would like to listen more. Today we talked about a generic how to build portfolio. So I see that you have a different setup also for, let's say, finding multi-baggers or let's say finding something which may be relevant 6 months down the line. So we would like to have few more times on this podcast.
Sure.
So,
Sure.
but for now,
Sure,
I
Amit.
would like to thank you for giving us this opportunity to know your strategies.
Thank you, Amitabh. It was my pleasure.
थैंक यू।
बहुत ही अच्छी क्वालिटी वीडियो साधन के माध्यम से आपको हम देते ही रहते हैं। तो बाय एंड लार्ज मैं बोलूं तो साधन प्रो और साधन प्राइम जो है वो ऐसे इन्वेस्टर्स के लिए हैं जो कि मंथ में एक आइडिया से ज़्यादा आइडिया के बारे में इंटरेस्टेड नहीं है। पैसिव इन्वेस्टर है, ही वांट्स टू आइडेंटिफाई न्यू स्टॉक्स जो उस मंथ में बहुत ही अट्रैक्टिवली प्लेस्ड है, जिसके बारे में हम लोग कॉन्फिडेंट है, तो हमारा कन्विक्शन हाई होता है, तभी हम उस पर वीडियो भी बनाते हैं। तो एक साधन के द्वारा देखा हुआ एक बिजनेस आपको मिल जाता है एवरी मंथ। सो दैट इज अंडर Sadhan Pro and Sadhan Prime. So I hope this would have cleared many of your doubt. And अगर अभी भी आपको कोई डाउट है तो please let me know in the comment. I would be most happy to answer those queries.